Hello, my name is Aaron Coulon. I'm on the Tulane University Burkenroad Reports analyst team with Patrick Rinaldi, Wei Wong, and Jingjing Gu. Our team is covering Conn's, which trades on the NASDAQ exchange under the ticker symbol CONN. My team and I would like to welcome you to our presentation of Conn's. In this presentation, we will cover our valuation of Conn's, the description of the company, an analysis of the industries in which Conn's participates and its shareholders, our investment thesis, and the assumptions we made in our financial model. As of November 16th of 2012, Conn's is trading at 25.71 with a PE ratio of 45. The stock price has increased 158% since November 16th of 2011. Our 12-month target price is $35. This is a 36% increase from its current price of $25.71, making our projection a market outperform. The valuation models we used to come up with this price were the discounted cash flow method and the price to earnings method. The discounted cash flow method gave us a projection of $30.82, and the price to earnings method gave us a projection of $38.95. We weighted these two methods equally and ended up with a 12-month target price of $35. We'll talk about the assumptions made in these valuations later in the presentation. Conn's is a furniture and electronics retailer. It has a wide range of product categories including consumer electronics, home appliances, furniture and mattresses, home office products, and lawn and garden equipment. It has 67 locations in Texas, Louisiana, and Oklahoma, with its headquarters in Houston, Texas. Conn's revenue comes from its retail sales, credit program, and repair service. For fiscal year 2012, 75% of its revenue came from retail sales, 18% from its credit program, and 7% from retail services. As you can see, its largest percent of retail sales comes from the consumer electronics with 33%, followed by home appliances with 29%, furniture and mattresses with 25%, home office with 6%, and other with 7%. Conn's offers three different types of credit to its customers. Conn's own credit program targets customers with limited access to revolving credit and limited disposable income, which makes up 30% of the population. The target customer has a credit score between 550 and 650. For customers with a credit score above 650, Conn's offers financing through GE Capital. For customers with a credit score below 550, Conn's offers financing through Rent-A-Center Acceptance, which is a rent-to-own program. In the second quarter of fiscal year 2013, 15.8% of its customers financed their purchases with GE Capital, 69.4% financed their purchases with Conn's Credit, and 3.2% financed their purchases with Rent-A-Center Acceptance. The percentage of customers who use one of these credit options to finance their purchases increased from 74.5% in the second quarter of fiscal year 2012 to 84.4% in the second quarter of fiscal year 2013. Most of this increase came from Conn's Credit. The industries in which Conn's participates are home furnishing, consumer electronics and appliances, and credit and debit. Home furnishing and consumer electronics fall under the broader industry of retail discretionary. Growth in these industries is determined by personal income, consumer spending, interest rates, unemployment, consumer confidence, and the development of new technology such as more energy efficient washers and dryers. We believe that the threat of new entrants in the retail discretionary industry is high because of online retailers. However, because Conn's also offers credit to go along with its products, the threat of new entrants into Conn's specific niche is medium because it requires a lot of capital to offer a credit program. We believe the bargaining power of suppliers is medium because while electronics and appliances are somewhat differentiated between brands, if one brand prices go too high, there are substitutes in other brands. The bargaining power of buyers is medium also because if someone is not dependent on the credit program, they can go to other stores to purchase the products that Conn's offers. But if a customer is dependent on the credit program, they have few alternatives to Conn's. The availability of substitutes is low because many of Conn's products are considered necessities. The competitive rivalry in the industry is high because of the many other companies within the industry. To analyze the shareholders, we looked at three key statistics. 52.3% of shares are held by the 10 largest shareholders. 23.9% of shares are held by insiders. A high percentage of shares held by insiders show that the people working for the company have confidence in it. The short interest is 36.8% of the float. The float is the number of shares that are available to be traded. A high short ratio can be seen as a bullish or bearish indicator. The key factors that affected our valuation are expansion, the changing of Conn's product mix, and its unique credit program. Conn's hopes to increase its total retail square footage by 50% by the end of fiscal year 2014. To do this, Conn's plans on remodeling 75 to 80% of its current stores and increase the number of stores by 10 to 15% annually. The new stores will be all opened in new markets so as to not compete with existing Conn's stores. Conn's also plans to shift its product mix more towards furniture and mattress sales. It decided to do this because this product line has higher margins than its other product lines. As you can see, furniture and mattresses was 13% of sales in fiscal year 2011, but 19% of gross profits. For the second quarter of fiscal year 2013, furniture and mattress sales increased to 21% and was 31% of total gross profits. Conn's plans to continue this trend of focusing on furniture and mattress sales, and by fiscal year 2015, it expects 30% of total sales to be from this product line. If it accomplishes this, the total gross margin is expected to be about 40% by fiscal year 2015. Currently, its retail gross margin is 34%. Conn's credit program differentiates it from its competitors. In recent years, it raised the minimum credit rating from 500 to 550. This tighter credit requirement should decrease bad debt. Also, because Conn's is focusing on higher priced items, more customers will finance their purchases with Conn's credit. The key assumptions we made in our valuation are a 10% annual new store growth rate, a 3% terminal growth rate for our discounted cash flow valuation method, and that all new stores will be successful. For this discounted cash flow method, we used a beta from Yahoo Finance of 1.7. We calculated an after-tax weighted average cost of capital of 10%. This method gave us a one-year target price of $30.82. For the multiples method, we used a peer group that came up with an average PE of 21.38. We expected earnings per share for the next 12 months to be $1.82. This method gave us a one-year target price of $38.95. The Burkenroad reports are produced solely as a part of an educational program at Tulane University A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you for listening to our presentation.